Welcome to the Broken Pie Chart Podcast, episode number 82. I'm your host, Derek Moore, and this week, let's talk a little bit about all this stuff you've been hearing about valuations and PE ratios and forward PE ratios. What's high, what's low? Is it really a good predictor of returns going forward? And sort of the changing nature on analyst estimates. And I think we've seen these, move around a little bit. So first of all, we know that earnings are down. Earnings have been down roughly 20%. Well, I shouldn't say roughly 20%. So in 2019, the earnings were $163 on the S&P 500. So what does that mean? Well, the S&P 500 index, when you say earnings, they basically aggregate, they add up all the earnings from all the companies, the 500 and something companies that are in the index. And that's how they come up with the sort of the per share. So when I say, 2019 was $163 a share for 2019, 163. That's, let's say the 499 companies reported nothing and one company reported, just tons of earnings. It's just aggregated all together. And, Professor Jeremy Siegel has often pointed to in 2008, earnings dropped something like 40%. And we'll come back to that because that's a little bit instructive on how, the time to recover back to previous earnings levels. But he always made the point that, in 2008, a lot of banks had massively negative earnings. You had a lot of companies write down different things. And, the market obviously went down quite a bit. But earnings so far, if the estimate, so remember this is big E as an estimate. The estimate for 2020, including the two quarters that have already, pretty much the Q2 is already fully reported, Q1 is reported. But the estimate, by the end of the year, they're saying, I mean the analyst, they're saying $129.88 is the consensus estimate on earnings for the S&P 500. And so keep that in mind as we think about, where earnings have gone and where they're estimated to go. And also, I'll kind of get back to the 2008 thing. And then we also want to look at this whole idea of, is the market, everyone says, well, the market is very, very high. And by the way, I'll just say this up front. I don't know exactly where the market's going to go. Those of you who've been listening for a long time know that, I'm a big believer in buying the market, but having downside hedges. So when you have using a strategy like that, it takes away some of the, the necessity or the precision needed to be right. Because look, if the market sells off materially, hopefully you have some hedges in place, and, real hedges, not just diversification that you hope will work. And if the market keeps going up, great, you capture the majority of the upside. It's missing that material downside that's really important. So when we think about price to earnings, for anyone who, maybe needs a refresher, I'll go through this really quickly. The price to earnings is you take a stock or an index, and you take that price and you divide it by whatever the earnings are. Let's make this really simple. Let's say a stock is trading at $10 a share, and the earnings per share are, so if you have 1 million shares outstanding and you have $1 million of net income, that's $1 per share. So stock's at 10, earnings per share is at $1. 10 divided by $1, that's easy, right? It's 10. And so you're trading at 10 times earnings. And then what happens is, let's say next year, the consensus estimate on this, completely fictitious made up stock are $2. So the analysts say, hey, I think they're going to earn $2 next year. Well, then on a 1 year or 12-month forward basis, it is trading $10 divided by $2. It's trading at 5 times forward earnings, okay? So let's look at what the S&P is doing right now. I'll round up. Not quite close at 3,400, but it's close. So I'll sort of round up. And so we have, if you look at what the earnings were last year, okay, or what the earnings are, let's say, if we actually end the year at 129.88, so remember, this is an index, it's not a stock. So it's the index level divided by the per share earnings on the S&P 500. So if we wind up being, 129.88, the index is trading at, an estimated 129.8. It's trading about 26 times the estimated 2020 earnings. Okay. And when you hear people saying, well, it's trading on the high side, that's sort of what they're talking about. And I'll give you some historical perspective on what was the trading before March of 2000. What was the trading before 2008? And so then you kind of look and you say, okay, so what is the market trading on a forward 1 year basis? And by forward 1 year basis, it's basically Q3, Q4, Q1 of 21, Q2 of 21, right? Because we already know what's happened. And the consensus estimate, it looks like, and it was actually raised recently. And by the way, that's a really good point, because these are just estimates. They can change, and analysts can be wrong. So if you're doing a forward estimate today, well, if the analysts change their estimates, and assuming the price doesn't change, you're going to have a different forward PE. So what we do is we take 3,400. Again, I just rounded up to make it easy, divided by the 145.66. That's the forward consensus analyst estimates for the next 4 quarters, $145.66. And that gets you about a 1 year forward PE of about 23.24. Okay. So when we look at, where PEs are, and we look at, historically, what does that mean? Well, before on February 19th, so that's kind of, the last high in the market before everything kind of went awry, as we say, in the markets, the 1 year forward PE was 19. And what did I just say? I just calculated it's about, 23, 24. Now, JP Morgan, I pulled up their guide to the markets. On August 20th, they had a forward PE of 22.3. Okay, so my numbers are a little bit different than theirs. They may be using their own estimates. I don't know. And at the very lows, on March 23rd of this year, the forward PE was 13.1 times estimated 1 year, going forward. So, and that was when the S&P was 2237. So what does this mean? Well, if we let's look at March of 2000, the forward PE ratio is about 27.2. We all remember what happened then. We know that the NASDAQ.com era kind of had a crash, and market certainly went into a recession. Interestingly enough, October of 2009, the PE was only 15.7. It's only 15.7. And then, of course, we know we had the 2008 crisis, 2009, all of those types of things, right? So we're currently probably higher than, the average. The 25-year average for forward PE is about 16.43. So we are at levels not seen since, 1999-ish. And then, of course, if we look at something like the Shiller PE looks at the last 10, it's the price over the inflation-adjusted average of the last 10 years' earnings. And over the 25-year average, Shiller PE is 27.35. The latest was 31.11. So it's actually not that higher than the 25-year average, but certainly it's, you could look at any number of things. And there's some people who debate whether the Shiller PE is useful or not. That's maybe off topic for another podcast. So does this mean that we're we're trading really high. What does it mean? Well, JP Morgan also has kind of the old XY regression scatter plot. That's just a fancy way for saying, hey, let's look at the 1 year forward PE, and then let's see what the return was when the 1 year forward PE was at that level. So, for example, if the forward PE is 17, there's sometimes returns were negative, sometimes returns are positive. There's definitely a sloping, and over the next subsequent 5 year annualized returns, there's definitely, if anyone's ever done a regression or stats, some of you are like, no, I don't want to ever do that again. But there seems to be some correlation between the higher the forward PE gets, the lower historically 5 year annualized returns have been. But like I said, if all of a sudden earnings start coming in better and the analysts raise their estimates, those PEs can go down pretty quickly. And by the way, this only had about a 45 R square, so it's not zero, but it's not 100%. Forward PEs and subsequent 1 year returns, by the way, that's all over the map, and that is a really low R squared. R squared just means, higher the R squared, the more let's say the correlation between something that you're looking at, and there's it's not really that predictive, right? So when you look at things like that, certainly that's what you see on CNBC, and you hear a lot of people saying, on a forward basis, the market is, trading very high, right? Here's the other thing I would tell you, that, if you look back and you looked at, a PE ratio, let's say, for example, in January 1st of 2009, the actual PE, not the forward PE, was almost 71. And we know the market bottomed out in March of 2009. But certainly that was, someone who said, wow, that's unreasonably high, and I'm never going to invest in the market again, would have missed out on, a decade plus of returns. So are we high right now? Is the forward PE high? It's higher than the average, certainly. But also, I think that there's an interesting thing here when you look at the estimates. And remember, these are just estimates. Analysts get stuff wrong all the time. In fact, analysts, this is a consensus estimate. But if you looked at the high and the low estimates on earnings, not only for the S&P, but on individual stocks, there could be a pretty high variance. So I found this interesting, and I'll take you back to 2007. 2007, 82.54 was the earnings on the S&P 500. 2008, they go down to 49.51. So that's a drop of 40%, okay? So they stay at 49.51 in 2008. They go to 56.86 in 2009. And they don't go above the 2017 level until the very end of 2010, when they hit 83.77. So I think that's kind of interesting in that, you figure you had 07, impairment on earnings in 08, impairment 09, and then it took, it was not till 2010. So, 3 years later, I guess 3 years, 3 full years later before they got back to the 2007. If you look, remember, these are just analyst estimates, but we were 163 on the S&P 500 in 2019. 2020, as I said, the estimate for the full year, you've got 2 quarters in, 2 still to go. So half the year is based upon actuals, half is based upon estimates. And it looks like they're, about 129.88. But here's what's interesting. Their estimates for 2021 are 165.69. That would be higher than 2019. And so if they actually do come in at the estimate for 2020, that's only a 20% drop in earnings in the S&P. And they would fully recover their prior level by 2021. 2022, by the way, they have 186.29, but that's pretty far off, right? So if that's the case, then the recovery, number of years to recover is lower based upon the estimates. And we'll see what happens. So the other thing that people like to look at is PE is price divided by earnings. You can actually invert that, and you can do what's called an earnings yield. So a lot of value investors, they look at earnings yield. Like they take the earnings, and so let's say the earnings are $10 a share, and the stock price is 90. So you take 10 divided by 90, and the earnings yield is 11.1%. So think about, if you're a shareholder, this is why a lot of value people look at this. They say, well, you want a high earnings yield because as a shareholder, that means you're getting, paid more. If you invert, let's say, the S&P 500, we'll use that 3,400 again, and we'll say over the next, 4 quarters, if you got 145 divided by the 3,400, that's an earnings yield of about 4.2%. What does that actually mean, though? Well, in 2008, 2009, somewhere around there, the earnings yield was, I think, 1.5 or 2 on a trailing basis, right? Not on a forward basis. So to be fair, if I kind of look at let's say if I use 129 divided by 3,400, that's more like 3.7, 3.8. And I've got a little bit of the estimate in there. And earnings yields tend to go really higher, right before, the end of the 70s, you had earnings yields that were, almost 14%. So, that's another way of looking at it. But I don't know that we can, deem that. Again, it's just better to be, if you're going to be in the market, just have some protection on the downside. Like, don't try and be looking to get in and out, trying to guess, is this the top? Is this not the top, right? So one of the other things I'll kind of touch on too is with this idea about forward valuation. And, everyone uses, I shouldn't say everyone, but a lot of people use historical numbers. And what do we know about the current environment that was very different from the very period, let's say, in the late 70s, early 80s? Interest rates. Interest rates are one of the components of, if you're trying to value the earnings of a company, or do an intrinsic value, a discounted cash flow on a stock or on a market, the earnings are discounted down, and they're discounted down by the cost of capital. And the cost of capital, of course, is, anyone's ever had a finance textbook knows the capital asset pricing model. Remember that long thing where you take, the risk-free rate plus the beta times the equity risk premium minus the risk-free rate, right? And you essentially come up with, hey, based upon the volatility and all these other things, what is our, cost of capital, right? So the cost of capital should go up when interest rates are up. And one of the reasons why it should go up is because, look, if you could buy a bond right now for 7%, or you could buy a stock, and you might say, well, look, I can do essentially a risk-free treasury at 7%. Why wouldn't I just buy that? Or heck, if it was 1981, you could buy 15% treasury. So the cost of capital tends to, demand for return on stocks, or the premium of equities over bonds should go higher when interest rates are higher. And I bring this up because, given where interest rates are, I think it's an interesting question to ask. Can we actually look at a forward PE or PE ratio today the same way we did when interest rates were much higher? And part of the reason is, remember the whole thing. It's a dollar today is worth $1, but $1 someone's going to give you in 2 years has to be discounted down by the opportunity cost, or the risk-free rate, or some other discount rate, cost of capital. And so I bring this up because I think a lot of times interest rates are a huge component in finance. And I think sometimes there's not adjustments made given where interest rates are. And so, kind of give you an example. If you were to receive, let's say, $100 in 2 years, right? And you said, okay, well, we're going to use 10% as the cost of capital. If you were going to get $100 in 2 years, you're going to have to discount that down. And $100 in 2 years at a 10% cost of capital or discount rate is only worth today, roughly $82.50. But if you're using, a cost of capital that's next to nothing, maybe 0.5% or something, or a third of a percent, then guess what? Well, that same $100 that you're going to get in 2 years, if we did like 0.33%, it's worth about just shy of $99.50 today. And I bring this up because I don't think that's talked about enough. And look, if you're doing this type of estimate and you're trying to say, well, how do I know what interest rates are going to be in the future? I know what they are now. And that's a fair point. But don't discount, I guess that's a pun, right? Don't discount what interest rates are. So anyway, this gives you some primer, a little more detail on, what you're hearing right now when people say forward valuations, PE ratios, what is the earnings yield? And then, sort of the earnings estimates. And so there's plenty, if you Google S&P 500, forward earnings estimates, there's plenty of places that put out their estimates, individual firms like Goldman Sachs and Citigroup and any number of analysts put these out on their own. So you can find them out there. And just remember, though, we just had the big, what do they call them? The fan mags, Facebook, Apple, Netflix, Microsoft. Oh, what's the other one? Alphabet, right? Or did I say that one already? Anyway, so all the high flyers, right? But all Amazon, that was the other one. So Amazon, they blew away their earnings estimate, I think. So the analyst had a certain number, and they reported their quarter, and it was much higher. I think Intel, didn't they miss their quarter by 10% or 15%? I forget. Or maybe that's what the stock dropped the day after. I can't remember. So these are estimates. These are estimates only. If you find this interesting, please share it with somebody. Rather than wasting time rating, reviewing, and scoring and starring and everything, go ahead and share this to somebody, especially somebody who hasn't listened to podcasts. Look, they're running out of stuff to, from all accounts, right? I don't know if you watch any shows that you watch. A lot of them are on hiatus. They haven't been filming, and there's not a lot of new content that's been coming out. I know Billions on Showtime. I think they ran through 6 episodes, and I was reading, I don't know when they're going to start filming again. But anyway, so I'll leave it there. And hopefully this was based upon a couple listener questions. Go ahead and reach out to me. I like hearing from the listeners. And if you want me to cover a topic, I will certainly do that. All right, everyone. Have a great week.